Hey guys, thank you for joining us today. I want to talk to you a little bit about forming different types of business entities. Your business matters. Your business entity must make a real difference. It has to do with money, both right now and the future. The right choices in building or building a business, you need to there are several different options. So we want to go through each one of those with you and talk about the different taxes and things of that nature. The IRS recognizes these businesses as business entities: a sole proprietorship, a partnership, a corporation, an S corporation. Note, an LLC is not considered a separate entity by the IRS. Business entity definitions. So let's talk a little bit about sole proprietors and partnerships. Sole proprietors, per the SBA, this type of structure can be good choice for low risk businesses and owners who want to test their business idea before forming a formal business. Partnerships. There are limited partnerships and limited liability partnerships. Limited partnerships only have one general partner with unlimited liability. All the other partners have a limited liability to them. So business entity and definitions: limited partnerships and limited liability partnerships. With limited liability partnerships, partners with limited liability also tend to have a limited control over their company. The general partner, the partner without limited liability, must pay self-employment taxes. Limited liability partnerships are similar to limited partnerships, but give limited liability to every owner. So I know that's a lot to take in. So hopefully if you have a pen or a pencil there, maybe take some notes on this, because there's going to be a lot of information. An LLP protects each partner from debts against their partnership. They won't be responsible for actions of other partners. Business entity definitions for C corporations. C corporations have completely independent life separate from the shareholders. If a shareholder leaves the company or sells his or her shares, the C corporation can continue doing business relatively undisturbed. Corporations have an advantage when it comes to raising capital because they can raise funds through the sale of stock. This can also benefit attracting employees. Corporations can also be a good choice for medium or higher risk businesses. They can be a good for business that needs to raise money. They can actually be good for businesses that plan to go public or eventually to be sold. Going to touch a little bit on S corps. S corporations is a special type of corporation that's designed to avoid the double taxation drawback of regular C corps. S corps allow profits and some losses to be passed through directly to the owner's personal income. This is one thing to know about the S corp. S corps allow the profits and some losses to be passed directly through the owner's personal income without ever being subject to corporate taxes. That's really important. Sole proprietors and partnerships. Sole proprietors are the same as their owners. The owner pays taxes on the sole proprietorship's profits. A partnership does not have to pay income tax. Instead, the businesses will pass through its profits through losses straight to the partners. Then the partners will include their respective share of the partnership's income or loss of personal tax returns. Business entity and taxes. Corporations. Corporations pay state and federal taxes. They sometimes pay local taxes. That will include income taxes on profits. The opposite of partnerships and it's the opposite of partnerships and sole proprietorships. For taxes for a corporation can end up paying taxes twice. First when it makes a profit, the second time when the dividends go to the shareholders. This is the case even if there's just one shareholder. So that's important to note. So taxes for S corporations. S corporations are also called subchapter S corporations. Only the wages of an S corporation shareholder is also an employee are subject to taxes, employment tax. Any remaining income is a payment to the owner as a distribution. Okay. Distributions are taxed at a lower rate, if at all. Taxes for LLCs. An LLC is not a separate entity according to the IRS, so it isn't taxed. Instead, the members pay individual taxes. Members of any LLC or an employment tax on the entire net income of the business. Again, the member of an LLC pay employment tax on the entire net of the income of the business. Sole proprietorships, the legal liability for them. Sole proprietorships, there are no limits to the personal liability. If a sole proprietorship did it, then it did so as one owner. This includes all debts and obligations and risks and actions of its employees. So that's very important to note there. Legal liability for partnerships. Partners retain the full shared liability. Therefore, partners are not only liable for their own actions, but also liable for the business debts and decisions made by other partners. Plus, all the partner's personal assets can be seized to satisfy a partner's debt. So that's super important when you're looking at a partnership into a business. The partners are also liable. So plus the partner's personal assets can be seized. That's really, really crucial to note. You may want to take note of that if you're in the partnership or looking to get into a partnership business. The legal liability of corporations. Corporations, within a corporation, the shareholders' personal assets are protected. The shareholders can usually just be held accountable for their investment in the stock of the company. But if an employee commits fraud or a felony under the corporation's direction, the corporate veil can then be pierced and the personal assets can be on the line. The obvious remedy, don't tell your employees to commit fraud or felony. So that's being a little bit Captain Obvious, but it's, there's serious ramifications to it. Legal liabilities for S corporations. S corporation or shareholders' personal assets like a personal bank account cannot be seized for the purpose of satisfying any business or business liabilities, like verdicts against the company. LLC and LLC members are protected from the personal liability for the business decisions or the actions of the LLC. If the LLC incurs debt or is sued, the member's personal assets are usually exempt, but not always, hence the term limited liability. Cost, shares, sole proprietorships, and LLCs. So I want to touch on this a little bit. Sole proprietorship, the owner is the company. If it makes money, so does the owner. Their share is 100%. Partnership, the partner shares the vary, and they should be clearly spelled out in the partnership agreement. If the shares are not specified, that's exactly right, John. Be careful. Partnership shares, they vary. They should be clearly spelled out in the partnership agreement. If the shares are not specified, they're assumed to be equal. An LLC is another type of corporation that the only real difference is the liability rather than the shares and costs. So it works with other corporations or like other corporations. We'll talk a little bit about costs and shares of corporations. Corporation is run by its board of directors and usually the owners. Ownership stakes are defined by what percentage of stock everyone owns. If one person has controlling interest over 50% of the stock, then their decisions will generally overrule everyone else's. Costs and shares, again, if shareholders have smaller stakes in the corporation, sometimes those shareholders will band together to influence decisions or even kick out existing board members. Usually it's done by a vote in the companies that I've been part of a shareholder of. Profits generally distributed per share percentages, though board members can take a salary. S corporation, a shareholder working for the company must pay him or herself a reasonable compensation. The shareholder has to get a fair market value, or the IRS may reclassify any additional corporate earnings as wages. Choosing the wrong business entity. A lot of businesses start off as sole proprietorships, but there's no separation between the owner and the business with this setup. Partnerships and another entity where the ownership and the business are more intimately connected with either entity, and any other efforts in separating the business and personal credit be all for naught. So that's pretty important. Incorporating the best. A corporate structure truly separates a business when the personal credit and finances. This is because the corporation is considered to be its own entity. Should you choose a C corporation, S corporation, or limited liability corporation, that's up to you to decide. We highly recommend working with a corporate lawyer and an accountant to determine what's best for your particular situation. Choosing your entity on the IRS website. I know this can be complicated for some people. When you're applying for an EIN, you declare your business entity at the same time. The Internal Revenue Service gives a brief definition of each structure type. To help you with this form, the further you go into the form, the more information the IRS offers. You can only have one responsible party apply for an EIN for a particular business per day. This is designed to treat all taxpayers fairly. And here's a link to the irs.gov. Special Case B, corporations. I want to touch on this a little bit. A benefit corporation sometimes can be called a B Corp for its profit and corporation recognized by most states. B Corps are different from C Corps in purpose, accountability, and transparency. But they are different from how they are taxed. Shareholders of the company accountable to produce some sort of public benefit in addition to the financial profit. Some states require B Corps to submit an annual benefits report that demonstrate their contribution to the public good. So that's important to note if you're getting into a B Corp. Special case closed corporations. Closed corporations are like B Corps, but they have less traditional corporate structure. They don't have they don't have all formalities that typically govern the corporations and apply to smaller companies. State rules vary, but shares are usually barred from the public trading. Closed corporations can be run by a small group of shareholders with no board of directors. Nonprofit corporations, 501c3 corporations, we get this a lot through building business credit. Can I build business credit with nonprofit? And the answer is yes, you can. But let's touch on this a little bit. Nonprofit corporations are organized to do charity, education, religious, literary, or scientific work. Since their work benefits the public, nonprofits can receive tax-exempt status. This means they don't have to pay state or federal taxes income on any profit it makes. Nonprofits must file with the IRS to get tax exemption. This is a different process from registering with the state where they're located. So a recap of this, business entities make a difference in taxes, liability, costs and shares. The choice is yours on how you decide. Now, what I will say in respect to this, as far as sole proprietorships go, is very difficult to build business credit off a sole proprietorship. Typically, most of the business creditors, the vendors, lenders, they ask for a personal guarantee. So note to self if you're looking to open up a sole proprietorship. My name's Scott Krakowski. I've been filling in for Ty today while he's out. If you have any questions, please contact our 800 number, 877-600-2487, and we'll certainly be happy to help you out. Thank you and have a great day.